Okay, so hello everyone and welcome back to our session regarding the learning about trading forex. And this is actually the first video regarding our second course, which is venturing into forex trading analysis and diving into charts. So the first topic under this course is actually the four types of trading analysis. And let's go. Let's start again. Four types of trading analysis under the venturing into forex trading analysis and diving into charts course. Okay, so what are the four types of forex trading analysis? Guys, in trading every financial markets, there's always an analysis that a trader, may it be a manual trader, a quant trader, or what any type of trader there is using before he or she will place a buy or sell position in the market. Okay, and we are actually trading forex market, and here I am going to present to you the four general types of forex trading analysis. Though, so the first one is all about the fundamental analysis, followed by technical analysis, intermarket analysis, and the sentiment analysis. So basically, what are these different analysis? Now, I'm going to explain to you one by one. Let's go first to the first one, the fundamental analysis. Basically, fundamental analysis is a way of looking at the forex market by analyzing economic, social, and political factors that may affect currency prices. In stock market, the fundamental analysis is all about understanding the financial statements of a company, okay, the financial standing of a corporation, and of course, the long term, the short term, the medium term, up to the long term plan of the management of the corporation. That's actually different from the forex market. In forex market, we are analyzing under the fundamental analysis. We are analyzing the economic, okay, condition of a certain country. Why? Because every economic condition of a certain country actually reflects to the movements of their specific currencies. Okay, it actually reflects on the movement of their economy's currency. For example, there is a new economic data release, for example, CPI, or the consumer price index, and that actually drives the inflation rate. So for example, that's actually came out, and then it will automatically reflect to the currency's movements. Okay, that's an example of economic. Okay, in social, what's happening in the surroundings, what's happening in that specific country, same as the political forces. Is there a new election? Actually, if ever there is an election, there is a possibility that that specific election can have an effect on the movement of your country's currency. Okay, so basically, fundamental analysis is more on the external factors. We are analyzing the external factors towards that specific country's currency. Again, economic, social, and political. For forex traders, regarding the economic data, we will going to cover it sooner. That's under the fundamental analysis course. We will going to have a course specifically dedicated for fundamental analysis. Same with social and political factors. Okay, so overall speaking, in generally speaking, bird's eye view, that's fundamental analysis. The second one, or just like this one, I have my data visualization for this economic data. Some of the most common economic data are the CPI, the interest rates, and the in US every Friday, the NFP, the non-farm payrolls. We will go into to dig dive on that. Okay, then natural disasters. These natural disasters can actually have an impact in your country's currency, of course. Central bank intervention. If ever the central bank will rate hike, or will the central bank make the rate lower, that's actually have an impact too. Okay, speculation, and then the political factors as explained a while ago, and of course in our previous videos. So the second one is technical analysis. When we say technical analysis, this is the study of historical price action in order to identify patterns and determine probabilities of future movements in the market. So basically, this is now you are being involved in charts. You are predicting if ever the price will go up or will go down based on its past data, based on the patterns that you are seeing, based on the indicators that is reflecting in your charting software. And this is what our focus now, no, in this course and up to the next course as the technical analysis. Okay? And the third one is the intermarket analysis. For the intermarket analysis, this is actually a method of analyzing the market by examining the relationship, okay, or the correlation of that specific market that you are trading compared to other assets classes. Okay, when we say other asset classes, other financial markets such as currencies, bonds, commodities, and stocks. So I have here an intermarket analysis cheat sheet. Actually, I will going to provide you a copy of this in PDF on the next part of this session, no, in our website. So for you, if you are watching this video in YouTube, please go to www.quantalpha.quantalphaalgorithms.com if ever you wanted to enroll in our course. So intermarket analysis cheat sheet. So let's explain this briefly. For example, we have here the gold, and the gold is on green. When we say green, the gold is going up. Okay, if the gold is going up, then basically the USD will go down. Why? The rationale is that investors often abandon the dollar in favor of gold when economy is in turmoil, because gold is actually considered as a safe haven asset. Okay, gold keeps its fundamental value unlike other assets. Another intermarket analysis. Gold. By the way, guys, gold is not part of forex. Okay, gold is part of commodities market. What we have here in forex are the currencies and the currency pairs. Okay, another correlation or another intermarket relationship is the gold versus the AUD USD. If ever goes up, Australian dollar and United States dollar as well as the NZD USD or the New Zealand dollar USD goes up also. Why? Because Australia exports about $5 billion $5 billion worth of gold annually, ranking as third in the world. Okay, as well as the New Zealand, they are ranking 25th. Okay, so gold and USD CHF, they have an inverse relationship. If gold goes up, no, USD CHF goes down. Why? Because when we see USD CHF goes down, USD goes down, but in fact, CHF goes up. Because again, the idea is if ever that we are selling the base currency, we are buying the code currency at the same time. And here, the code currency is CHF or the Switzerland. And we all know that gold is used to back almost 25% of Switzerland's reserve. So the pair declines as gold prices to rise. So meaning, the Switzerland franc is being bought. Okay, another correlation, gold and USD Canadian dollar. They have an inverse correlation as the Canadian dollar has the fifth largest producer of gold worldwide. Okay, the Canada. The pair often moves lower. CAD is being bought while USD is being sold because again, gold and USD have an inverse relationship. So going to the next part, we have the oil and USD CAD as the inverse relationship. They have an inverse relationship for the reason that one of the top 5 oil producers in the world is Canada. Okay, it sends over 5.5 million barrels of oil to the US every day. The pair declines as oil prices rise. Okay, another thing, gold and Euro USD, they have the same direction. Okay, so they are directly proportional. Why? Because euro and gold are major or generally being considered as anti-dollars or anti-dollars. Okay, as anti-dollars, gold and the euro are both expected to rise in value if gold prices do. Okay, another concept or another analysis for the intermarket for the bonds and domestic currency. Guys, bonds is another financial market. It is not part of forex. It is not part of commodities. It is not part of stock market. It is bond market. Bond market is a separate market. But bond market, if ever that specific country's bond market goes up, that specific country's currency goes up as well. But why? This is the rationale. An economy that provides greater bond returns draws more investment. Due to lower bond returns, its local currency is more appealing than that of another economy. Oh, by the way, bonds is most considered as a safe investment. Okay, so another analysis, intermarket, the DJIA or the Dow Jones Industrial Average, this is actually the uh, one of the stock exchanges of the United States of America. When Dow Jones goes down, the Nikkei goes down as well. Now, what is the Nikkei? Actually, Nikkei is the stock exchange of Japan. Okay, if the US has the Dow Jones, has the S&P 500 and the NYSE, Japan has the Nikkei. Okay, the rationale is that the health of the American economy is directly correlated with the Japanese economy. Okay? And same goes as well with Nikkei and the USD/JPY. Okay, they have this directly proportional relationship. So if Nikkei goes down, USD/JPY as the forex currency pair, major currency pair, goes down as well. Why? Because if we sell USD/JPY, that's again, no, we are selling US dollar at the same time we are buying the Japanese yen. Investors view the yen as a safe haven, just like the gold and just like the USD somehow, and frequently turn to it when the economy is in trouble. Meaning to say, if the Japanese economy is in trouble, is in going down, the Japanese yen actually goes higher. Yes, that's the rationale behind. Okay, so that's intermarket analysis. The fourth one is what we call the sentiment analysis. When we say sentiment analysis, no, this is more on analyzing how other traders feel about a particular currency pair or the entire forex market given some current market conditions. Because actually, my friends, any market is driven with emotions, especially Forex, considering that Forex is the largest financial market in the world. So that is driven by emotion. Diba? Let's face the reality that when we are happy, we can actually click the buy, 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 buy. When we are angry, we can actually have a range trading. When we are sad, we can have a low volume of transactions. When we are excited, we can have high volume of transactions. So that's how emotions are being uh, connected with financial markets, especially in forex. So any market is driven by emotions. That is the near concept of sentiment analysis. And with sentiment analysis, we are trying to gauge what is the market, what's happening in the market. If we are afraid, no, more likely that's the market when go down. If we are excited, if we are greedy, that will be the time that the market will go up. Okay, for example, in during the COVID-19 pandemic, the market is actually the whole market. Any financial market is actually in trouble because that's a black swan. COVID pandemic is a black swan, once in a lifetime event, and we are all afraid. No, we don't know. We all don't know what will happen in the future. So that's how sentiment analysis relates to forex market. Again, we have, as part of our review, we have the four types of forex trading analysis: the fundamental, the technical, the intermarket, and the sentiment analysis. This is again from the Quantalpha algorithms. If you want a free course regarding forex trading, comes with a certificate of completion, just go to our website at www.quantalphaalgorithms.com. And if you are looking for some brokers, we have the list of recommended brokers below in this video description. Thank you everyone, and see you on our next trading session or learning session. Goodbye. Thank you.